Good afternoon, everyone. Just wanted to share a quick video with you about what's going on in the markets right now and answer a few questions. We've had a bit of a wild run for the last few weeks, and I've had a few questions arise around the market declines and also questions about inflation. So I thought I'd take just a few minutes and talk with you a little bit about both of these topics. We're going to discuss corrections and inflation here for the next few minutes. First thing is just a couple of quick disclosures, and mostly past performance is no indication of future results and all the other rigmarole there. And so let's look at these two things. The first thing I want to talk with you about is whether or not we should expect a correction soon. First of all, let's just talk about what's going on in the markets right now. We've seen a fantastic year so far. The U.S. market, as recorded by the S&P 500, as you can see, peaked out a few weeks ago, back on September 2nd, at about 20%, almost 21% here at the top of the market. Since then, however, we've seen kind of a steady decline, and the market bottomed out just a little bit earlier this week at negative 14.6, 0.7, and bounced a little bit today and is back up to a positive 16%. So first of all, it's hard to complain too much about a year so far when we've earned 16% on the U.S. stock market. But the most recent volatility makes it feel a little bit acute, since in the last 4 weeks, we've seen nearly a 5% decline in the U.S. stock market. So the question then comes as to whether or not we should be expecting a correction. We define a correction as a 10% decline or greater. Is that something that's imminent in the next little bit, or should we just expect the market to come back? Well, the answer to that question comes in a couple of different forms. First of all, I will suggest that, as we've said before, the U.S. stock market is a little bit expensive right now. And so that extra price to earnings ratio tends to make it a little jumpy, if you will. So volatility will increase whenever the valuations are higher, because frankly, it takes a lot less to tip the market over whenever the valuations are high. And there's no question that they are high. However, I would like to demonstrate one thing that I mentioned in the last webinar that I did, which is that we have segments of the market that are very, very expensive, but still have a pretty firm footing under that expensive stock price, which is in the form of earnings growth, and then the remaining stocks, which are maybe not as expensive as the rest of the market. So the first thing here is, if you look at the top 10 stocks of the S&P 500, the current PE ratio is 30.7, which is pretty extraordinary if you look at it just in that sense. And the average PE for those same stocks is only 19.7. So you have to make the argument that anything that's 156% of the average is overpriced. And then you look at the remaining stocks of the S&P 500, and this is priced back just a month or so ago, but the remaining stocks are trading at 20 times earnings, and their average is 15 times earnings. So again, 128 times, but 128 times is not 156 times. But there's no question, just based on that one valuation metric, that things are pretty expensive. But I want to draw your attention down to the right here. And the thing that's compelling about what's happening in the market right now is that while earnings expectations are high and have been growing, the top 10 stocks are really at a bit of an extraordinary pace right now. And you can see here that as of August 31st, they were contributing 28.4% of the earnings of the S&P 500. So 10 stocks contributing 28.4% of the earnings. So the question is, are those stocks expensive? Well, at 156% of the average, you would say yes. But when you look down here at the earnings of those 10 stocks, you would say, well, that's maybe not as bad as it appears. And I would say that's the real story of the market. Difficult to tell exactly how expensive it is. No question it's expensive, but is it very expensive or just a little bit expensive? Well, there's a compelling argument that maybe that part of the market is not as expensive as it appears. The rest of the market is overvalued, but maybe only about 128% of the average, which a good part of that you can explain by low interest rates. So the first thing is not to panic too much about valuations where they are right now, even though that they're high, but that higher valuation may make the market a little bit jumpy. So I would say that the answer to your question is, should we expect a correction? I would say we should expect a correction, but probably not for the reason you think. If you look at this chart, what it shows is the returns of each year, positive and negative in the bars, and then the intra-year decline. So in other words, how far the market fell at its furthest decline inside that 1 year. And what you'll notice is that every year, nearly every year on the chart has an intra-year decline. Even when the year was positive significantly, you still see intra-year declines. And those intra-year declines average an amazing 14.3%, which means that if you add all these up, all these declines, these intra-year declines, you add them all up, they average 14.3%, and yet in 31 of the 41 years, the market was still positive. So intra-year declines are not unusual. They happen almost every year. In fact, if you look statistically on average, even the 10% corrections happen almost every year. So when we look at what's been happening lately, we see, of course, an intra-year decline last year of 34% on the S&P 500, and it still ended up a positive 16. But what's interesting is we really haven't seen any volatility to speak of since then. So our intra-year decline for 2021 is only a negative 4%. So while you can point at a lot of different factors and say, well, maybe China is creating this volatility, or maybe the Fed announcements is creating this volatility, or in the news today, it was the Biden administration and the Democratic expansion plan and tax plan is creating this volatility. The truth of the matter is volatility is normal, and we haven't seen any volatility to speak of for the year, which means we're overdue. So I'm going to go out on a limb here and just predict that, yeah, we're probably going to see a little more volatility. And will it decline a full 10% for a correction? Well, it's anybody's guess. There are many years that it doesn't decline 10%, but there are quite a few years that it does. And if it goes down 10%, it's nothing to worry about. There's no more significant issues in the market than there were, before. It's just typical volatility. If we see further declines and there's a little bit more higher declines later on, maybe we'll have some concerns about that. But at the moment, it looks like normal volatility to me. So expect a correction because they happen every once in a while anyway. It's a good idea to expect it, but don't worry about the volatility. It's absolutely normal at this stage. Now, I want to touch on the next question, which is coming up often about inflation. The good thing about inflation as it stands right now, while it has been high year over year, it's really not very far out of the range. So what this graph tells us, if we look back to 1971 and you remember the days of very high inflation rates as measured by the CPI and core CPI in the late 70s, early 80s, these rates are astronomical, 15% or so. And then you look at these rates as they trail back down and in this range of 0 to 3% most of the time from the, I guess really from the early 90s forward. That's essentially what we've seen in terms of inflation, below 3%, but within this range of 2 to 3%. The last 10 years, inflation has averaged about 1.5%. So what we've seen over the last few weeks, months, with the recovery from last year's declines is that we're seeing higher inflation. We dipped down significantly where inflation last year, you can see, was almost zero. And then we basically have bounced off of that zero. So the year over year inflation numbers are high. But if you look at the 50-year average and even, the June 21, July 21 numbers on the 50-year average from back in the 70s, including those high years, you can see core CPI was at 3.8%. Year over year, we're about 4.5, 4.2 through July. So higher than average, even when you consider having those 70s and 80s time frame in there. So it's definitely higher year over year. And even the headline PCE and core PCE deflators, which tend to be a little bit lower, are high, relatively speaking. But let me shed some light on that. There's something that's going on right now, and you'll hear arguments about the inflation rate being transitory because of supply chain disruptions, et cetera. But I really want to show what the market believes the forward inflation rate to be. So we're seeing high year-over-year inflation rates, which should not be surprising at all, given the fact that the inflation rates dropped to nearly zero last year. We're talking about year-over-year rates. It was zero last year. So, I mean, my goodness, if it goes up at all, the inflation rate climbs significantly. But what about the next few years, 22 and forward, 5 and 10 years out? what's the market really saying about this? Well, there are three measures, and these three measures are illustrated here, where you see consumer expectations, which this is basically just a poll by the University of Michigan to ask the average consumer, what do you think inflation is going to be over the next 5 to 10 years? Pretty simple answer. Most of the consumers think inflation over the next 5 to 10 years will come in on average about 2.9%. That's higher than it has been, about double what it's been over the last 10 years, but really much lower than the long-term average, which is somewhere around 3 or 3.25. So even the consumer expectations are a little bit modest in terms of inflation going forward. But the professionals and even the market itself, when you look at the bond market, the 5-year, and the 10-year tips break-even rates are much lower. So the professional forecasters are saying 2.4. We're seeing that consistent across many of our forecasters, the chief economists of companies like JP Morgan and Vanguard and Fidelity, and these companies that are very large and have lots of resources to do the research, they're coming in pretty consistently in that 2 to 3% range and settling right in those low twos long term. Now, 2022 may take a little while for the inflation rate to settle down, but we're talking about after 2022, those inflation rate numbers are coming in relatively low. And even the tips, 5-year, and the tips break even, which is basically a 10-year treasury versus a 10-year inflation adjusted bond, which you net those two things out and that gives you the inflation. And they're still coming in low twos, 2.25. So while you have some obvious concerns about spending in the Biden administration, spending overall, and the debt that we have to service going forward, and all the money that's gone into the accounts, and the demand that we may see from the extra supply, basically what we're seeing is there aren't indications right now that we're expecting outrageous inflation rates over the next decade. That's subject to change. I mean, we may get a new data set going forward, but right now we really don't have any significant evidence that there are signs of inflation that we should be concerned about. And so I would just say that, at least for the time being, nothing to worry about. Until we get something to worry about, I don't worry. So there's nothing to worry about here. It looks as though inflation will be a little bit higher, but just maybe marginally higher than the Fed's target in the beginning, which was around 2%. And we'll probably see that settle out in the next couple of years. So the big story about all of this is that, as always, and the thing to keep in mind is the long-term plan. So we see this interim volatility this year. Feels like a little bit of a surprise because we haven't seen any volatility for a while, but it's normal volatility. And we have these inflation expectations that are a little bit higher than what we've seen before. But you know what? We've seen inflation much higher than it is now, and inflation outrageously high. And look what the stock market has done through all of these administrations. It just happens to continue to plow higher and higher and higher. You see periods of volatility like the early 2000s, and then 2008, and then we saw the correction recently. And so you see these periods of volatility, but what does the market do over time? It does what capitalism does. It continues to grow, continues to expand. We just have to make sure that we rebalance, that we're part of that expansion, and we're keeping our heads all along the way to make sure that everything is in place as it should be. So no worries on our end. I hope you're not concerned about it. And in the meantime, we want to thank you very much for your trust in us. We have a great appreciation for you. Hope you have a really fantastic weekend and a restful time. And please don't hesitate to let me know if you have any questions about anything, and I'm glad to help you. Talk with you soon.